All right, so now that we went through chapter 1, which was pretty much an introduction to accounting, we went over what accounting is in chapter 2, and now we went over we exposed you to how to record a transaction. Now, chapter 4 is basically going to review all the guidelines and the reason why we have to do things a certain way. So we're going to be looking into the accounting cycle, and we're going to be looking at the infamous, actually not infamous, they're pretty famous, generally accepted accounting principles, okay? So let's go ahead and dive right in to first things first, the accounting cycle. So first off, what is the accounting cycle? It is a series of steps that you are required to properly put together basically all of your work. And what it does is it ensures the accuracy and the conformity of the actual financial statements. So what does that even mean? Well, first, we want to make sure. Our number one rule is to make sure that our debits match our credits, right? But when we dive into doing the financial statements, that's where all your calculations come together, and it needs to be in perfect unison, as in like we need to follow the accounting equation, right? We need to follow those guidelines, and we also have other rules as well. Okay, so it's also a collective process of a recording and again processing the accounting events. Okay, so what this accounting cycle is, I don't really want you to know per se the actual definition. What I want you to remember is going to be the 10 steps to complete the accounting cycle. So again, general rule of thumb is when we are looking at our financial statements, we want to make sure that they're accurate. But in order to validate that it's accurate, we need to make sure that our information is 1, reliable, 2, it's relevant, 3, it's consistent, and 4th, that it is comparable. Now I'm going to talk about each one. Reliability, right? The purpose of doing accounting is to make sure that our sources or the things that we're doing can be backtracked or can be referenced, right? We want to make sure that everything that we're doing is reliable, as in we need proof of documents to verify that this transaction has even happened, to make sure that these transactions hold up to be true. Okay, so it needs to be reliable information. Okay, second thing is it needs to be relevant. Relevant meaning if we're doing journal entries for the month of June of 2020, we want to make sure that we stay within June 2020. You don't want to throw in things that you've written out for January or February or even prior years to that. You want to maintain relevancy. You want to make sure that everything's up to date and that everything is up to par. Because I can guarantee you, tax tables from 10 years ago, it's not the same as it is today, okay? And tax tables always change every year. So you want to make sure that you're up to date and keep everything and all your financial information is relevant, okay? Third thing is consistent. Consistent meaning you're using one type of system and you're going to be consistent through it all. Now, what I teach here in accounting is I'm going to expose you to all the methods. However, as either you as the accountant or you as the bookkeeper, well, the accountant makes the decision, but you have to follow what the accountant says. But if you are the accountant, you must choose one rule and stick with it. Okay. Now there are some rules when it comes to choosing a specific type of way you're going to calculate things. So we'll talk about that when we go into inventory. There are 3 options you can choose from that I teach you in this class, and you can choose one. You could choose all 3, just depending on which product. Now, if you choose let's say, for example, I choose my inventory of hats. If I choose to use one type of method, I need to stick with it throughout the entire time I'm journalizing it throughout the years, because I need to keep my information consistent. I can't switch from another method to another method. And that's going to also go along the lines with when you decide whether you're an accrual or a cash basis. Are you strictly cash or are you strictly accrual? Okay, so you want to make sure that you're recording everything with a consistent method. Okay, and lastly, comparable. This is because we want to make sure that when you produce your financial statements, we want to make sure that your guidelines is easily recognizable as well as comparable to other companies. So again, because we are looking, we actually cannot compare ourselves from a private company to a corporate, but we should see similarities. However, what I mean by comparability, being comparable, is you want to make sure that your financial statements is comparable to another company in the same industry. Meaning, if I'm a restaurant, a small business owned private restaurant, mine and another small private business restaurant need to have similar, if not comparable, financial statements. If they're doing something different, and I'll talk about the rule about that, you may want to follow along the lines. If they've been in business longer than you have, you may want to follow what they're doing, because ultimately you want to make sure that your stuff is comparable to theirs. And another great thing about being comparable is when you release these statements out to the public, because you have to, actually not for private, but for corporations, you do have to post it to the public. You want to make sure that your investors are able to look at it, because possibly if you're doing well, then another company you might be chosen to be invested in, or in other sense, incorporated in. Okay, so those are just the things that you need to know as far as the two. Yes. Are you guys, is everyone still there?
I'm still here.
Okay.
Yes. Yep.
Okay, good. It was just a little too quiet. All right. So what I really want you guys to know is there are four characteristics, right, of financial statements, right? So the 2 R's and the 2 C's: relevant, reliable, consistent, and comparable. Okay. So yes. So let's go ahead and dive into the 10 steps of the accounting cycle. Now, in this course for this class, we are going to explore all 10 steps. Now, the first half of the class, we're only going to recognize up to step 3 for the first half of the class, okay? Steps 4 through 10 will all be involved when we dive into our class project. So, just a little FYI to see what you're expecting in for, or so you know what to expect is what I mean. So first, right now, I'm going to show you the first 3 steps, right? The first one, the first 2, we've already looked at through transaction analysis. The third one is going to actually journalize these in your general journal. So steps 1 through 3, we've already seen, we've already done an example, and again, I've only taught you very basic understanding of journalizing. We need to cover about 4 or 5 separate topics for you to recognize how to journalize it before we can actually dive into the rest of the steps. So step 1 is to analyze the source document, to collect the source document, meaning any receipts. Let me see, hold on. Did I separate each one? Yes, I did separate each one. So step one, okay, is to verify and to collect your source documents. So that entails anywhere from any receipts, any invoices, any bills, any type of form of document that you can provide. But and usually that's going to be your best form of a source document. Now, for instance, let's say you do your bank transactions, you do online, you can also print your bank statement. Your bank statement is considered a source document. I'm trying to think of any instances where you don't have a paper trail, we call it. Um, but most oftentimes you will have, or you should actually create some type of paper trail. So for example, when you have a checkbook, you should utilize that booklet that it comes with to record your transactions, because ultimately that is a source document for yourself to hold on to. Okay. Um, Oftentimes what happens is a lot of companies, what they do is they make copies of their checks before they send it out, just to prove that they have their that they've written the checks to that specific person, and that's considered a source document. All right, contracts are considered source documents as well, checkbooks, and yes. So that's step number one, is to gather all the information before even doing anything further. Step two is to, yes.
My apologies. This is Vina.
Uh-huh.
All the new like virtual money or apps like Cash App,
Uh-huh.
Venmo,
Uh-huh.
and all of that, would that be fall under this category?
So
Under
what what you can do is, so most oftentimes what happens is those kind of virtual we call them electronic funds transfers. Those kind of things, you're able to backtrack it through your bank statement or your credit card statement, depending on what it's linked to. So you do have a source document by either going to the bank itself and asking them to send you a bank statement, or you can actually go online and be able to print out your bank statement right then and there. So that would be considered your source document in regards to using those kind of applications.
okay.
Okay. And like I said, it's very, very crucial, especially when you're doing accounting, to have a backup source. Oftentimes, I'm guilty of this too. Every time I go make a credit card transaction or use my bank card, they give you a receipt, I trash it, or I tell them, no, thank you. That's bad accounting, because what if I need to return a product? Oops, I didn't even have a receipt. Or oops, I don't know how much I actually spent, or how much is actually I'm supposed to use as part of my, I don't know, reimbursement check, whatever it is, right? So that is also why you need to be very careful, because let's say you do make a mistake and you do record a transaction and you don't have the backup source for it, you could, and then if you get audited for any reason, you can get into trouble if you don't have that proof of source document. So that's why most accountants, as funny as you want to laugh at it, back in the day when I said I want all your receipts in a shoebox, that's what used to happen in the past. You would organize all your receipts, put them in a shoebox, and go through them one at a time, just to make sure that all the receipts and proof of information is there. Okay? Yes, yes, yes. All right, so step number two is how to analyze your source document and sort the data. So here I made a little fictitious example for you to understand how to analyze your source document. So again, this is a receipt from, I believe, some random company I just made up. I think we bought, what, supplies? Yeah, we bought supplies, right? Now, how to analyze it is you're going to answer these three questions. When did it happen? What happened? And how did it happen? And those three things will justify on will also help you do your transaction analysis, right? So for example, the first question is, when did it happen? You got the date right there on the receipt, so you know when it happened. And then what happened? Well, you bought something, right? This is a receipt from a store. So this is a proof that of purchase. So that is what happened. You bought something. You bought supplies from a store. How did it happen? Well, here on your receipt, it tells you that you paid in cash. All right. So now there you go. I analyzed my source document. I recognized and I answered those three things. Okay. And it gives you the total of the amount. So you're not blindsided. Obviously, it's a receipt. It tells you how much you paid and how much you owe at that point. So this is how you analyze a source document. So step 3, again, we recognize this from chapter 3, is you're going to actually record this transaction in your general journal. Of course, you got to determine which general journal you're using, of course. So one could be for operating activities, whatever you want to call it. It's not technically for inventory. It's for general operations. So here we're going to record it that on June 6th, I purchased a total of $61.09 of supplies, okay? Now, notice I written it for $61.09. If I look at my source document again, I was actually taxed $4.66. So my original price that I purchased it for was $56. But why am I recording it for the full amount? Because when we're dealing with this, when you're making a purchase of something, you include tax everywhere you go because you paid into it. All right, so think of it that way. Now, when you're dealing with sales, okay, when you're dealing with sales, you need to separate the tax, and we'll talk about that when we dive into inventory, when we start making sales. You are going to have to separate tax because what you're doing is you're collecting money, and that tax is something that you are going to owe and pay into the government afterwards, okay? And in this case, we actually paid another store $4.66 worth of tax. So therefore, our supplies is not worth $56, it's actually worth $61. So make sure that you understand when you're journalizing it, you need to include every single thing, including tax, shipping, whatever it is. It's going to be included in your total price. And that's exactly how much you spent, right? You're not going to record $56 and say, I spent $61, but in reality, I spent only $56. No, you're going to recognize it for the full $61.09, including the tax. Okay? So I bought office supplies for $61.09, and I spent the cash for $61.09. Boom. Once you've done that, then we want to go ahead and do step 4, which we have seen before. You're going to post this to your ledger account. Now, what a ledger account is, it's a list of all of your accounts with its respective account balances. So in this case, I'm going to be dealing with 2 ledger accounts, my cash balance, and I'm going to deal with my office supplies because that's how my journal is, okay? And when we dive into the in-class project, you're going to see how you journalize to your journal and how you post it in your ledger, and they need to be identical, all right? So here in my cash ledger, it says that I started off with $2,000. I spent my $61, so now I have my running balance is now $19.38. So then when I'm dealing with my office supplies, since it's my first time purchasing supplies, here I recognize that I purchased supplies for $61. Therefore, my my running balance is going to be starting off with $61. Okay? And so that's how you post to the ledger. All right? Then after that, what you're going to do is you're going to start preparing for the trial balance. Now, when we go into our scenario, we're going to actually be doing the trial balance quite often. And it's actually recommended to do your trial balance as often because you want to ensure that your debits and your credits match. But not only that, you want to make sure that when you were journalizing and you were posting to your ledger that there was no mistake or you overstated an asset or you understated a liability, meaning you wrote too much money in assets and you wrote too little on your liabilities. You want to make sure that you do this quite often is because you don't want to find yourself journalizing. You made the mistake on the first day 7. Let's say day 7, I made a mistake, and you're all the way down to the bottom of day 30, and you're finally doing your trial balance, and you're going to be wishing to yourself when you find a discrepancy, if your debits and credits don't match, you're going to spend hours and hours finding that mistake. And the worst part is finding the mistake either in the very beginning or finding the mistake at the very, very end. And believe it or not, that is the purpose of being an accountant, is once you make that mistake, you got to go and find it before you can move forward on anything else. If you cannot find that mistake, you cannot proceed because that means your financial statements will be wrong. And then your entire performance on doing your accounting job is not very good at that point. You need to make sure that you do your trial balance quite often, and you can do it every day. It just depends on how many transactions flow in per day. Now, in the case study, we're going to do it every week, and you'll see what I mean by every week. But yes, generally we want to do it often. And what the trial balance does is, again, it's a list of all of your accounts, and you want to make sure that your debits match your credits. And if they do, you are successful because you've accomplished the accuracy of your accounting. Okay. Now, so at the end of the at the end of the trial balance, your debits must match your credits. Then the next step is going to be doing your adjustment entries. So you will learn this further on in the course, okay? You'll learn what adjustment entries are. And adjustment entries are basically things that when you're doing your business, you need to calculate things that happened in your business. So a good example is what we did today earlier. You need to adjust your inventory, right? You need to make sure that that you know how much inventory you have on hand and that you need to make that adjustment every time you sell a product. Okay, so that is a perfect example of what an adjustment entry is, right? So same thing, if you buy supplies, you're not going to have supplies sit in your office unused for a whole month. If you open it up and you start using it, you need to calculate how much of those items you actually use. And that's called the adjustment entry. And typically it happens at the end of any given period. And we'll talk about what a period is because a period can be anything, all right? And we'll talk about that later. So again, other examples would be depreciation, right? Depreciation, how much did you use your machine for, right? You need to adjust that. Other things would be cost of materials, bad debt expense, okay? We will look at all 5 of these throughout this entire class period. So in this case, I'm going to recognize that since I bought $61.09 of supplies, at the end of the month, I end up using $50 worth of the supplies. Okay, so that means I should have a remaining balance of $11 and something and 9 cents, right? And you will recognize that once you've entered this into your general ledger. Okay, so once you've done your adjustment entries, then you're going to do an adjusted trial balance. So basically, you want to make sure that when you did your adjustments, that you did your adjustments correctly by making sure that you do another trial balance to ensure that your debits and credits match again. Okay, so yes, this is tedious, but again, we are trying to prevent yourself from making those accounting mistakes. Because oftentimes, like I said, you can make a mistake in the beginning of your week. You can make the mistake here at the adjusting trial balance at the very end of the month, right? You can make a mistake anywhere, and you want to make sure that you want to rule it out as soon as possible. So that's why we need to create step number 7, which is to create the adjusted trial balance. Once everything is settled in and your debits and your credits match 100%, that's where you can go ahead and move on to step 8, which is actually preparing your financial statements. So again, we looked at 4 financial statements. We got the income statement. We have your statement of equity. We have your cash flows as well as your balance sheet. Now, if for any reason, again, all of these will come together, and you'll see it's actually really cool. Once you finish journalizing and doing your trial balance, you're going to piece together this information. And the great thing about that is once you piece one information at one time, so if you build your income statement, you're going to build your equity statement, and you're going to build your balance sheet, what you're going to see is that every single sheet will produce the same answer. And once you get the same answer, that will guarantee you that you did your accounting correctly. And then, yes, so again, it's amazing when you put together your financial statements and everything comes out perfect and everything matches from your journal to your ledger to your statements, okay? So again, you're going to be looking at how much did you make a profit for, how much is the value of your company, does your assets match your how much you owe and what's the value of your company, and lastly, how much cash is actually flowing into your company as well as flowing out of your company. All right. And then step number 9 is going to be closing the books. So in order to close the books, what you're going to do is you're going to zero out all of your temporary accounts. So that means you're going to close out all of your expenses, you're going to close out all of your revenues, and you're going to close them out to what's called the income summary. All right. So corporate standpoint, it's going to be retained earnings. In private companies, you're going to be looking at income summary. All right. So here's an example of zeroing out my sales into income summary and then zeroing out my expenses into income summary. Once you've completed that, you're going to zero out your income summary to your equity. And this number here, the when you go back to your ledger, that equity should equal your statement of equity. So again, once you start piecing together, you're going to be amazed that once you get the correct answer and everything matches, you're going to feel good about it. But if things don't match, you're going to stress yourself out about that. All right. And then lastly, to completely verify and to ensure and to just completely close out your books permanently, that is where you're going to redo your trial balance with the post-closing trial balance. So again, you're going to verify that your equity is correct. You're going to verify that all your debits and your credits match. All right? And that is all 10 steps to the accounting cycle. All right? So again, we will, in this course, go through every single step of every single step in the accounting cycle. Okay. So the next thing I was going to talk to you guys about is the accounting period. Now, the accounting period is pretty straightforward. It's whenever you schedule to complete the accounting cycle. All right? So, that means in instance, an accounting period is whenever you want to complete all 10 steps. Now, depending what kind of company you are, you can choose to close your books every day, every week, every 2 weeks, every month, every 6 months, or every year. Okay? Now, the maximum you can go is for every year. You can't do it every 5 years. Okay? So the maximum you can do is every year. And there's the guideline for rules for GAAP is going to apply to this concept right here, that it has to be within a year. And when you do it, you get to determine that as well. So again, now depending on the company that you are working with, is it beneficial for you to close your books out every day? If you're a very, very small company, closing your books out every month isn't a bad idea. But if you're like a super big, huge corporation, I'm going to use Walmart again, where you're dealing with millions of transactions per day, you would definitely want to do that on a daily basis, just so then it doesn't bite you in the butt when it comes to the annual reports and you're dealing with gazillions of transactions that happen in the course of 365 days. So, I mean, it's just, it's just depending on what kind of company you are. What do you think is the most beneficial? Do you have the time to complete the accounting cycle? So, just seeing how much information you need to have to even complete the 10 steps of the accounting cycle, you can see it takes a lot of time and a lot of work to actually close out a book properly. So daily is a goal, but it's not a realistic, I would say, unless you have a separate team that can do it for you. Most oftentimes I do see often is going to be a monthly report, or oftentimes I know that a lot of major companies, they do quarterly reports. So they release their statements every 3 months, and generally that is a nice way to do it. Okay, so instead of waiting till the end of the year to record a gazillion transactions, right? The best way would be determining what kind of company you are and what works for you. Now, when you do it, you have 2 choices. You can either go for calendar year, which is the easiest one, all right? Most companies follow calendar year just because it's easy. It's easy to remember. You start on the first day of the first month, which is January. So you can start January 1st, and you're going to end on December 31st. Done. Right? No need to figure out anything else, right? And you're going to file your taxes for that year either in April or March, okay? Typically during tax season. But if you're able to just make it simple, I'm going to start my period running from the 1st of January and end on the last day of the 12th month. Okay, then yes, calendar year will work for you, and most companies again go for calendar year. Now, most government agencies or public agencies, such as schools and such as public transportation, right? The bus systems, right? They all go on a fiscal year. Same thing with the government here too, right? The state, local, everything that's government run they typically go for a fiscal year, which is meaning they can determine any year at the start of any month as long as it's for 12 consecutive months and it starts on the first of the month and it ends on the last day of the 12th month. Okay, so most often cases you'll see that for government agencies is that their fiscal year starts on July 1st and ends on June 31st, or June 30th. Okay, so typically they do it in the middle, right? Why? Maybe most cases, a lot of businesses, they choose to do fiscal year because depending on what kind of business they are they busier in the summer or are they more free in the summer? And in this case, most cases of governments is they're more busier in the winter or slash fall and not so much during the end during the summer, so then they can file their taxes and prepare. They have a method of to why they choose it that way is because they're less likely to be busy in the summer, so that gives them time to prepare their statements and whatnot and prepare their taxes. Okay, another example for that would be like a swimsuit company, right? You're more likely to see a swimsuit company use calendar year because they're more likely to be more busier over the summer versus over the winter and fall time. Okay, so that is what a accounting period is. All right. Any questions as far as up to now before I dive into the generally accepted accounting principles?
No, ma'am.
All right. No one else? Okay, so I'll go ahead and dive right into the generally accepted accounting principles. So, what are they? Who are they? Well, it's not who, but what are they? Who makes them? And why do we even have them? So again, we're going to break it back. Well, so basically what this is basically financial standards and methods, okay, used by accountants to ensure the accuracy of accounting, but it's some kind of systematic rules and guidelines that you have to follow in order to produce accurate financial statements. So here is a more perfect definition for you. It's several rules and standards and assumptions that you need to follow. Yes, in order to have those guidelines to be protected. Now again, why did we have these rules? And again, I'm going to keep talking about it. It's because of Enron. Okay, they violated every single rule out there, so that's why they decided to be more stricter and create these guidelines and make sure that every time you file your taxes, that's the first thing that you're going to do is they're going to make sure that you correctly follow the rules, and if you don't, you're going to get audited. Okay. Now, again, because we are beginners in this, the rule for the generally accounting accepted principles is actually more than what we teach here in class. But these are just the basics guidelines that must hold true for financial accounting. But when we move into more advanced accounting and we dive into managerial accounting or for even forensics accounting, once we go beyond the scope of beginners, the accounting accepting the rules for GAAP is actually more extensive, and yes, and these rules from the last time I've heard of it has not changed for a while. Yes, because the one that I learned back in 2014, they're still the same. Now that's because I learned it for the recent ones, but back in the past, I have no clue if it was a lot more different before or as it is now. But I know that there has been some changes And the person that actually creates those is called the FASB. Who doesn't know the FASB? They're the Federal Accounting Standards Board, okay? FASB for short, okay? And they are the ones that come up with these rules, and they are the ones that ensure that people actually follow these rules, okay? And as extra as the United States is, this is only going to be applied in the United States, okay? The United States only uses GAAP, okay? You cannot apply GAAP internationally, which we've talked about before. And if you're in an international business, you cannot apply GAAP to it, okay? Meaning if you have business outside the U.S., you cannot apply U.S. GAAP to, because you're a U.S. company. No, you unfortunately you're not able to do that. But yes, GAAP, it is for the United States only. Okay, and we'll talk about the rules in a second. And then for international, for the international rules, so anything beyond the U.S., it's going to So far, the well-known one is going to be the ISB, which is the International Accounting Standards Board, and they primarily focus on the IFRS, which is the International Financial Reporting Standard, the IFRS. Okay, so that one it's geared primarily for Europe or European countries and other ones, but so far as from my best knowledge, I only know that ISB or the IFRS, they only are protecting, or they only govern Europe and maybe some coastal regions on the East Coast, such as like maybe I think some areas, maybe India might be in there, but I don't know about for surely China. Now, because China could have a complete separate standards board over there. I don't have a clue. Reason being is because not that I don't care about it, but I was just want to let you know that we want to focus on the bigger ones and the primary ones, which is going to be the United States, which is understanding the gap. But yes, if you do potentially want to go overseas to establish a business there that's a United States company, you do need to follow the other guidelines such as the IFRS. All right. So now we can go ahead and dive into our first section in the US GAAP, and that's going to be the assumptions. Okay. So, once I go over all the rules, I'll tell you some techniques on how to actually understand or memorize these information. So in this section of GAAP, it's going to be your assumptions. So first rule is the business or economic entity assumption. Now, this rule basically says, for whatever reason, if you're a sole proprietor, right, you need to keep your business and your personal separate. Okay? If you're donating your personal assets into the business, then you need to transfer that title over and say it's for your business. You can't write it off as a personal asset, okay? You need to determine a fine line between your business and your personal issues. So for an example, right? If you open a bank account, yes, your name is on it, but your business name is on there too, okay? You cannot use your business credit card to pay off your rent for your own home. That's a personal asset of yours. That's your personal responsibility. You cannot do that. But what you can do is, if you are the owner of the business, you can write yourself a check saying, I'm the owner of the business, I'm going to write myself a check, and then you can cash that check out and then you can pay your rent. That is a complete separate of being personal versus being your separate business, okay? So I've seen oftentimes, and it's not wrong, but you definitely don't want to abuse the power. I'm going to use my business credit card to pay lunch for everybody as a business expense. Okay, you can call that off whatever you want to do it. But if I want to use it because I want to personally have a nice conversation with my friend, no, no, no. And if you get audited for that, you're going to definitely get a hefty fine for that. Okay? So again, that's why usually when you have a bank account, it is completely separate from your personal account. You can link them together, but again, general rule of thumb is when you create your account, your bank account, it's going to be a separate entity. Of course, your name is on it, but it is going to be a separate bank account from your personal account. All right? Second rule is going to be the going on, I always say going on, but the going concern. All right? Now, what the going concern does is it makes an assumption that even if you have a foreseen foreclosure for any reason, let's say you know that your company is in the waters, right? It's under the water, and you know it's going to you're going to lose your business. You still have to maintain operations as usual, as in you need to keep going until that day comes, okay? As in, like, for many examples, right? You always see that, oh, this company is going for foreclosure, right? They announce that they're going to go into foreclosure, but they're still doing business as usual. For example, Forever 21. I still went to Forever 21 and I still shopped as usual. Yes, I got a huge discount, but they still were still selling their products as usual, as if they know that they are going to go out of business, but however, they're still continuing their operations. They're still having their sales. They still have forever21.com for you to buy and purchase everything. They're still continuing their operations until the day, until someone, I believe, I don't know who, but I believe someone bought out Forever 21 to save them. And that's what oftentimes a lot of businesses will do. So now that instead of stopping their operations, they're now continuing going on for the long stretch that they're still surviving. So for that example, even if they have a foreseen foreclosure, they still need to maintain and continue doing business until the day that they absolutely cannot do it anymore, until they close their store. So that's the going concern, is that you're going to continue doing as usual. And then number 3 is going to be the monetary assumption. So this one's broken into three little subsections, okay? But they do fall under the same idea. So for example, monetary unit, okay? So this one is going to say you want to use the most relevant type of currency. So of course, in the United States, we use a US dollar, right? We need to use the most up-to-date and up to current dollar value as of today. We cannot use a dollar value that happened 10 years ago. All right? We need to use the most relevant and most current up-to-date currency. And in this case, we use a US dollar. I don't have a clue how much it's worth right now. It could be, I think it's, if you compare it to another foreign country, we usually compare ours to the gold standard, but our dollar is probably equivalent to like $1.56 in euros or something like that. Okay, so that means our dollar is weaker than the European money. Okay, and yes, so that's just one way of understanding that when you are dealing with money, you need to make sure that it's the most accurate and up-to-date current form of money. Okay, and actually, I believe there is a website that you can look up the currency, and it will tell you every single day of how much your money has fluctuated. So I'm pretty sure if you look it up today, it's probably dropped so low because why? because we're pushing in more money into the economy. We're printing more cash. So we're causing a really huge inflation as of today. All right. Number 2 rule under the monetary assumption is monetary measurement. So again, this is when I was talking to you guys, remember about the inventory. You cannot write that you have 75 items on hand. You need to have a value to it. Okay? So that is what money measurement is. It means that you need to have some sort of monetary value to everything that you do in regards to a company. So a good example is, I'm not going to write that I have 12 employees. I'm going to write how much it costs me to have a total of 12 employees. Okay? All right, and then lastly is a stable currency, which kind of goes along the lines with number 1. You want to make sure that you're using some form of currency that is a stable form of currency. So in this case, ours is backed up by the gold standard. So you want to make sure that with that, you're also making assumptions that inflation is a possibility. Okay, you want to. Oftentimes, a lot of people say that inflation is ignored. And well, in this case, in order to validate the first one, you need to allow inflation to be in an assumption to validate the currency that you're using. You need to incorporate the inflation. However, what this one's more geared towards is if you're doing projections, maybe you're predicting something, then you can use the current dollar as of right now. So, because obviously if I say I predict I'm going to make $10,000 in sales in 10 years, that $10,000 could be way more than what it is now, but I'm making a projection as of today. Okay? Lastly, for the assumption, here is going to be the accounting period. So this is what I was talking to you guys about when I said that GAAP mandates you to make sure that you have an accounting period at all, okay? And the maximum you can do as far as an accounting period is up to 12 consecutive months. Okay, so one whole year. You need to determine an accounting period. Okay, and you do need to report everything to IRS. Okay, you need to report what kind of method you're running your business. You need to let them know how are you going to be filing your taxes, whether you're doing calendar year or fiscal year, and how often are you going to be reporting. They need to know all of that, and that's why the accounting period is so important, because the assumption is you need to report your proper accounting, your financial statements, and the maximum you can do it is within one whole year or 12 consecutive months. Okay? So that is what that assumption is. Any questions about assumptions? Yes.
I do have, when you were mentioning, explaining the business, the number one, which is business or economic entity,
Uh-huh.
using an example as a sole proprietorship,
Uh-huh.
you know, um, most of sole proprietorship or owners, things like that,
Correct.
the mere fact that those should not be incorporated with your personal expenses or transactions is that it is more advisable for your business to have your separate tax ID number,
Correct.
the business tax ID number, versus using your own regular personal SS, whatever.
Uh-huh. Uh-huh. Social Security number. Mhm.
Yeah.
Yes, that is very true, and we will talk about that when we move into the payroll chapter. Okay, so yes, it is. I think nowadays you have to apply for a business identification tax ID number. Yes, you need to, it's called the employer identification number. You need to apply for one when you make your business. Yes, you can use your social security, but then again, basically with the social security is just to make sure they run a background check to make sure that you have the capacity or the credibility to own a company. That's all that the personal SSN is used for when you're dealing with a company. But yes, if you have employees, you definitely don't want to use your own social security for that. I don't think you can. You have to apply for a separate business employer identification number in order to do business like that. Okay, especially when you're filing taxes. Yes, you need to have a separate ID number. And yes, I don't know if that answered your question or not.
No, I just wanted to
Confirm.
inform, to add it to that because when you were using that as an example.
Yes, yes, that's a good one. Yes. Any other questions about assumptions?
Not from my end.
All right. Then we're going to go on to basic principles. Now, basic principles is going to gear towards majority to your journal. Okay? So the first assumptions is just having the idea. Okay? Getting the concept through that you need to have these assumptions as a way to form your business, right? You need to follow this rule. You need to be separate. You need to make sure that you do business even if you have some kind of form, right? You need to use some kind of system to record your money, right? Your basic principles is going to gear towards your actual journal process. So the actual transaction and portion of doing your business, right? Now, and that's going to be entailing number one, historical cost, okay? So this is very, very important that you understand what historical cost is. So historical cost means when you make a purchase of an asset, right? Whatever it is, land, building, equipment, whatever it is. Even purchasing inventory, whatever it is. You want to record it at the value, at its fair value, meaning the day that you buy it is going to be how much it is going to be recorded, and that's how much it's going to be worth as of that day. Okay? Now, this concept here is only applied to accounting. This concept here does not work for especially real estate. Now, real estate follows a completely separate guidelines because the minute you buy a house, you have what's called equity, which is completely separate from this kind of equity. You have equity, right? Over time, your home increases in value. The land increases in value, correct? In this case, no. When you record an asset, let's say you bought a machine that's worth $5,000, and in time, it's no longer going to be worth $5,000. Why? Because you used it, right? You used it, it's no longer, its motor is not good. Things are going to happen to that asset, and you can no longer sell it out into the public for what you originally bought it for. Okay? You have to depreciate it. You have to do all these things, these necessary things. But, however, if you do sell it, you cannot, let's say you sell it and you actually got money for it, like you gained out of it. You cannot record that your asset was valued at $10,000 when originally you purchased it for $5,000. You cannot recognize an unrealized gain, okay? Where if you buy a home, right, in a different standpoint, so I can kind of make you guys understand this for sure, that there's a clear difference between accounting and real estate, is if you buy a home, you use the crap out of your home, but in like 10 years later, it becomes higher in value. In this scenario, it does not work. And yes, you can sell it at a higher value, whatever it is, right? In this particular accounting, we do not we do not have those kind of gains. We do not recognize gains that come out of thin air. Okay, it is what it is. You buy it, you use it, you sell it. It's going to be for whatever original price that you purchased it for. Then that's final key. The only exception that can apply to this is going to be your securities. So bank bonds, okay, bank bonds, securities, things like that, as well as inventory, okay? Because inventory, we'll talk about that when we go into chapter 6, is you're gonna realize that inventory can either lose its value over time or it can actually increase its value over time, and you can adjust it according to the fair market value, meaning you are able to adjust your inventory um, um, based on what the market perceives the inventory is valued at. Now you want to be careful because oftentimes you're going to get more of a loss than more of a gain, depending on what product it is. And of course, securities, right? If you're buying a bond, the purpose of buying a bond is because you want it to collect interest. You want it to, increase in value. So that is why securities is also one of those things that we don't record a historical cost, because that does have a potential purpose of a gain. All right. And then the second thing that I want to talk to you guys about, the basic principles, is going to be realization, or also known as revenue recognition. So this is going to be very, very easy to understand. So when you sell a product, you're going to recognize that you gained something, right? You received revenue. That's why it's called revenue recognition. When you sell a product, you're going to record it immediately. That's called revenue recognition. Yes, that's pretty much it. Revenue recognition. So the minute you sell something is the minute you record it. And that's pretty much it. So just making sure that you've earned by doing so. Now, there are things that we will be looking into. Let's say someone paid me to do something, but I didn't do it yet. Then you cannot recognize it just yet, because the whole point of revenue recognition is you want to make sure that, yes, you can record the cash, but you need to record your actual service the minute it happens. Okay? So that's what revenue recognition is. When something has occurred, an event has occurred, you need to record it as right now. So this one goes along aligns with the accrual basis, which we'll talk about after this. Third concept is going to be matching principles. So again, if someone paid you money to do a service ahead of time, so we call that unearned revenue, right? They gave you pretty much a prepayment. Your job is to, at the end of the day, you need to provide that service and you need to match it for the amount that they paid you for. So that is what matching principles is you're matching all revenues with every expense that entails with that sale. Okay. Now it doesn't have to be just expense; it could be an asset, but you want to be careful on making sure that your revenues and your expenses are matched up first before introducing a third type of account in there. So oftentimes we would say, again, yes, you would, it's cash is not an expense, but it is a form of way of matching things together with your actual revenue. Okay, so that's all that matching principle is if you sell a product for $30, you recognize it, so you have an equal and opposite of amount. So if you, for example, rent expense, if you need to pay rent, you need to pay rent in service of doing your business. So that's matching principle, that they need to equal for whatever amount that it is equivalent to. Okay. And then lastly, adequate disclosure. So again, we talked about having 12 employees earlier in the scenario ahead of time. Now, your 12 employees, they're not just any employee, right? They could be salary-based employees. They could be wages-based employees. This employee has children. This other employee is married. Where do you put that information if you can't journalize it? And this is where the statements to the notes to the financial statements come into play, because that is where you need to disclose all of those information. Instead of writing on out for the example that I said earlier, you have 12 employees, right? But you're going to record in your journal that you're going to record how much it costs to have those 12 employees, and where you journalize or you disclose this information saying that you have these 12 employees, and actually break down in particular, oh, well, this person's wages, this person's salary, and you're explaining this person takes up about this much of the $1,000, and this person is on a wage basis. They can average anywhere from X amount of money to X amount of money. So that is where you're going to have you have to have the notes to the financial statements because it's a rule of GAAP, okay? You need to have it because it's pertinent information for your company. You can't just turn in your paper and say, I have $20,000 worth of employees. Where in the world is anybody going to know how many employees you have? You could have one employee take that $20,000 itself. You know what I mean? So it's very important that you disclose all that information into the notes of the financial statements. And that is one of the principles that you have to have. Okay? Any questions about the basic principles?
Would bartering fall under matching?
Mm-hmm. Say that again?
Okay. Would the concept of bartering fall under matching?
Did you say lottery?
No, bartering. Bartering. When you exchange a service for money, well,
Bartering
for
and
time,
trading.
yeah. So with that, for trading, exactly. So there's no money exchange. It's a service for
For a
a
product,
service or a product.
right?
Yeah. So I'm just saying with that, with these principles, because a lot of people, especially if what we're living in now, we're doing the bartering. You do this for me, and then I'll do that for you, and you have to add. I mean, it equals a monetary value. Basically, do you have to kind of report that under matching, or maybe that's somewhere down the line we're going to learn
Okay.
about bartering?
Okay.
BATRING something.
I understand what you're saying. So basically a service for a service. Now, yes, if it is, for example, we're a testing center, right? I say if you can test my students, in exchange, I will bring people to your testing center.
Good example.
Yes. Yes, as long as it's a true business transaction and it has some kind of dollar value into it, okay? Then yes, I am providing a service for you and I'm going to complete it by making sure that I hold up to my agreement. And that's why contracts is also very important, because contracts also is part of the accounting part, right? It's one of these source documents that you should have, especially when you're contracting with another person. Now, does it have to be specifically dollar value? In this sense, yes. So you have to be like, if I can send you $20,000 worth of students to your testing center, because you're going to be facilitating, you're going to be proctoring them, whatever it is, because you're providing the service to us, we're essentially paying you $20,000 because we're shipping all those people to you. Yes. And when you match it the day it happens. So that's why matching and revenue recognition, they go hand in hand, right? So is my service worth $20,000? Then yes, That's why it's matching there, because let's say it's $100 per student. I don't know. Average it out. Find out what the actual per person is, and is my service worth that much amount of money? Then yes.
Right.
Then that's where the matching principle comes into play, saying yes. If you do this for this amount of money, I will accept your offer and match you, hence matching, by providing that exact service that you asked me. So that is revenue recognition. Yes.
Makes sense. Thank you.
Mm-hmm. Any other questions in regards to the principles? Okay. All right. Lastly, we're going to go into constraints and constraints in conventions. So what this is more, I would say, not super important as much as the first 8 that you just saw. This one is more geared towards how to, measure yourself in as far as comparing your financial resources to other places, right? So for the first one is going to be materiality convention. What this means is basically, are these items that you're recording, are they significant enough to put a dollar value on it? Okay, so for example, right, I have gems. Okay, now yes, we put a dollar price on it because we value it, but how another person values it, they could be like, oh, those are just pebbles, right? It's not worth anything to me. But in today's society, a gem can be worth anywhere from $20 to $100, depending on what the background or what materials is made out of, right? So that's what I mean by, is it significant enough for you to record or enough for you to even place a dollar value on it? Okay? And that's what materiality is. Okay? For example, that was the perfect example, is, can you put a dollar value on it? And if it is, then is it worth to record? Is it significant enough to report? Okay? Now, I don't have a real example to actually, that's actually a common one that most people often see. But, that's the best example I can think of is, again, having a material and putting a dollar value in it, and if it's significant enough to report, is pretty much all I can say. You can apply that to pretty much anything in your house. For example, I have a picture frame, right? A picture of my family, right? To me, it holds a sentimental value. To other people, it's worth nothing. So, in my sense, I say it's worth a lot of money to me, but someone else can be like, no, it's worth nothing. And that's what kind of materiality brings is. It's like, can you put a price value on it if I were to sell that picture frame? No one would buy it. They might buy it for the picture frame itself, but not the picture. But something like that, right? Or like a painting would be probably a better idea, right? But that's materiality, is like, can you give this material a value into it, and if it's significant enough to report? All right, second thing that we're going to be looking into is cost benefit. Now, this is a tricky kind of one because it's actually not that tricky. It's pretty straightforward, right? You have 2 alternatives, right? And the alternative is going to give you, so basically what this decision is when you're doing cost benefit convention is, you're going to weigh your options. So straightforward, you're going to weigh the cost it takes to produce the item, and does it benefit you in the long run? Okay, so you're going to be given an alternative, and you're going to create assumptions, or create some kind of theory behind it to say, is this worth producing for the benefit that is it going to benefit me in the long run. So the definition here is it going to benefit you to release your financial statements to the public? Okay. And that could be a yes or no answer. But let's think about it. Let's say it costs you $1 billion to produce those financial statements, right? Let's say you're $1 billion company, right? But it takes you $1 billion to produce the financial statements. Now, the benefit there is if I were to release it out to the public, a potential investor may look at me and be like, oh, I should invest in Walmart because they're doing so great. But it cost me $1 billion to produce those financial statements. But is it going to benefit me to release it? In this case, oftentimes that's how most companies entice stockholders to want to buy their stocks, to want to own a piece of the company. They release their financial statements in thinking that, hey, look at me. I came up with a new idea and look, it's profiting. I'm making a huge profit. So yes, so in this case, Walmart would benefit that because of how many shareholders they have. So that is what cost benefit means. All right. Another example I used is if you are in the manufacturing company, right? Let's say you're a t-shirt company. Is the cost to produce the item here in the United States going to benefit me? When I can also, my alternative is I can just ship it overseas and get it done because it's a lot cheaper, right? It's going to benefit me because it's going to cost less money. But the only problem is the overturn is going to be I get the product a week later, maybe even 2 weeks later. Where if I spent a little more money, yeah, I can get that product done in 1 day in the United States. Okay, so that's cost benefit right there. Now, conservatism concept kind of falls along the same lines as cost benefit, right? It's actually saying out of the two choices that you've made, the alternative, the one that you're going to choose is going to least likely overstate or understate your assets. Meaning, when you actually attempt to do this, you're not going to get a huge benefit. You're not going to get a huge, deduction in your cost. You know what I mean? So that's what conservatism is just to make sure that when you make your decision, that this decision does not affect your financials as much as you would like for it to happen. So for example, if I were to make my shirts here in the United States, that means I gotta raise my prices. And if I do that, then right here, I'm making my decision, but is it gonna benefit me? Like my alternative, is it going to conserve me? No, because I had to spend more money. Therefore, I need to mark up my price value in order to compensate. So my assets are overstated. Now, if I were to go to send it off to another country to do it and ship it back here, my assets, yes, it's going to cost me less. But as far as that, it's going to probably least likely overstate my assets because I didn't make such a huge expenditure. I made a really low cost. And that's the alternative, is to make sure that your assets, that you don't overstate your assets. And that's what conservatism is. Lastly is going to be industry practices. So again, I did talk briefly about this one. So what industry practices does is it actually says that anyone that's in the same industry as you, for the comparability to work, or if you're looking for an investor, your financial statement should look similar to someone that's in the same industry as you. So again, I don't know, Carl's Jr. and McDonald's, right? They're two fast food major corporation. They're both chains, right? Their financial statements should look similar to each other. Now, let's say McDonald's decides to do something different to their statement, right? McDonald's been in the game for a long time. They've been around since, I don't know, I'm going to guess the 50s, 60s, 40s, I don't know. But Carl's Jr., They've been only around for the 70s. So they see that McDonald's is doing something and they're benefiting from it, or they're making their change in their statement is actually allowing more investors to look at them. So what Carl's Jr. is going to do is they're going to kind of follow the same line as McDonald's. They're going to be like, what is McDonald's doing better than I'm not doing? And then kind of pulling Carl's Jr. up in the same game. And that's what industry practices is. If someone in the same industry as you is doing something different, you kind of want to gear towards them so then your financial statements actually come together and they're more comparable. They're easy to read. I don't know what you want to describe it as, but they're just more together. They're more uniform, right? Instead of having one wacky one that you can't even read, and then McDonald's is like all professional and all nice and neat and organized, you're more likely to choose McDonald's over Carl's Jr. because they produce some like easy to read financial statements, where Carl's Jr. like you need to get your game on, kind of like you need to fix yourself and make yourselves look like a little more professional, so I'm able to look at your financial statements and maybe I'll invest in you. So that is what industry practices is. Generally, you would want to follow the same guidelines as what someone else is doing in the same industry. Any questions about constraints and conventions? Again, these four I don't think is as super important unless you are like, I think the first 8 are more important, but these are definitely things that you need to be aware of. Okay? Any questions about constraints and conventions?
No, but fun fact, McDonald's was established in 1940 and Carl's Jr. in 1941.
No way. That is so funny. That is so funny. Oh, that's a great piece of information. And I should definitely look into that. All right. Now, the last concept I'm going to be teaching you guys is going to be the cash basis versus the accrual basis. So, we are coming up on time, so I'm going to try to finish this up as fast as possible. So, cash basis versus accrual basis. This concept is by far pretty straightforward, okay? If you're on a cash basis, right, that means anything and everything that you do is going to be based on cash, right? You're going to record your sales or revenues or whatever it is. You're going to record all of that the minute you receive cash. And then when you record your expenses or spend your money, any expenses, they're recorded the minute you pay with cash. Straightforward, okay? Nothing hard about cash basis. That means your limitation is you can only run your business if you have the cash to fund it, okay? So, so again, the minute you receive cash, or when you recognize your sales, revenues, whatever your income, is when cash is actually physically received in your hand. Cash is there. Check is okay because check is a form of cash, but no credit card, okay? Because that's virtual money. You need solid cash, okay? And in order for you to pay off your either expenses or pay off your liabilities, let's say you owe somebody money, which in this case you can only record those expenses the minute you actually have cash to spend, okay? Where we're looking at the accrual basis kind of gives you a little freedom and a little room when it comes to recording your income, right? You allow people to write you IOUs, okay? So in this case, you record income the minute the service or the product is sold. So when it's earned, okay? Once the job is complete, you've earned it, it's recorded. You do not need to have cash readily in your hand. You can have people write you IOUs. In other sense, accounts receivable. You can have people owe you money. And how expenses are and debt are recorded is going to be the day it happens, okay? All right? The day it happens, it's going to be recorded. Whether you owe that money or not to them, whether you get a bill for them or not, the minute it happens, you record it. Okay? So, again, cash basis is when you have the ready, let's do an example. I have a bill. Because I had someone, I contracted somebody to create the landscape for myself outside in the front yard. I get a bill, okay? For cash basis is you will not ever record that bill until you pay it with cash or a check, okay? So that means if I receive the bill January 1st and I don't pay it until January 12th, then I don't record that bill until January 12th. Where on accrual side is the minute I receive my bill is the day I record it. So in this case, if I receive the bill on January 1st, I'm going to record it January 1st. Even if I owe that person money, I'm going to record it on January 1st because it has incurred. The event has happened. Okay? And that is it for that. Does anybody have any questions in regard to cash and accrual basis? We are going to look at an example on Monday. Does anybody have any questions in regards to cash and accrual basis?
Can you re-explain again? Because the way I understand, correct me if I'm wrong, is that on the cash basis, is it more something like that is liquid? In other words, you have the cash available immediately to. So
Yes.
since you receive it, so it's a liquid cash type versus the accrual is, I do not know. Please re-explain again.
No. Okay. You are right when you say liquid. Yes. You need to have cash readily available in order to pay something off. Okay? So in this sense, you can owe people money, but when you actually record it is when you actually receive cash. So for example, if I made a sale, right? I made a sale on December 1st. I sold some toys, but they wanted to give it to me on an accounts receivable. I don't record that sale until that person has paid me in whatever method they use. If they paid me, so let's say they paid me on the 15th of December, I will record my sales on the 15th of December. Why? Because I actually have the cash in my hands. But I made the sale on the 1st of December. Okay? So this is just recognizing when to record the transaction. Okay? So in this case, cash basis, I don't record it until money is actually in my hands. Same thing, I don't record expenses or any payments until the money leaves my hands. So yes, you need to have cash available in order to do these things. And most cases, I will tell you this, most small businesses that start off, they start off as a cash basis because if you go ahead and do accrual basis, right, you have people owe you money. When we'll talk about that when we go into receivables is you have a potential that those customers may not pay you back. And then if they don't pay you money, you don't have money to pay the people that you owe. So that's why it's a lot safer to use cash basis. A lot of stores like those mom and pop shops that sell food or whatnot, like a local store, they may be like cash only. In my hometown, they used to have a donut shop with a sign that says cash only. Why? They're a cash basis. They only accept your sales when cash is received, is given to you. And if you don't have cash, sorry, I can't sell to you. Okay? So Cash basis is when you have the money available, it's in your hands, and then when it leaves your hands, that's when you record your expenses. So you record income when cash is received, and you record expenses or payments when cash is available for you to spend. All right? Where accrual basis, right? You have to record when it happens. Okay, so for example, I have a sale, I record it the day it happens, and because I earned it, I earned my sales. And then the second part is it's when it's incurred. You record expenses and your payments when incurred. So the example I gave you was a bill, right? Because a service has been provided and done for you, you're getting billed for it. So therefore, you have to recognize that something has happened for you. And yes, and it doesn't mean you have to pay now. You can pay later. And you don't need to have the cash readily available for you to record it. It just means that you're keeping track of when it happened. So that's why it's important. Cash basis time is not sensitive. In accrual basis, time is absolutely sensitive. You record the minute it happens. Okay? Any other questions about cash or accrual basis? No? Okay. So here's a course review. So again, here I summed up a little chart for you to recognize the 10 steps of the accounting cycle, what the accounting period should look like. I gave you a little table for characteristics of your financial statements. Understanding calendar is from January 1st to December 31st, whereas fiscal year is the first on the first month and all the way to the 12 consecutive months. So it ends on the last day of the 12th month. Okay. And then lastly here, I gave you a little summed up table. Now this one, it doesn't give you definitions, but this, how I teach to memorize the accounting principle is, it's just like you're learning your ABCs, right? You got your ABCs, meaning your assumptions, your basic principles, and your constraints. A, B, C. And understanding that there are 4 in each letter, okay? So I don't have a mnemonic device to memorize what each one is in each category. But I'll leave it up to you guys to be able to create something creative right there. But I just know that if you know to understand GAAP, you're going to learn your ABCs, which is your assumptions, basic principles, and your constraints. ABCs, okay? And understand there's a total of 12, and there's 4 in each one. All right. Lastly, we're going to be, I talked about cash versus accrual basis. Again, you only record income when cash is received, and you record expenses and payments when cash is readily available to be spent. Whereas accrual basis, you record when you record income when it's earned, so the day it happened, the day that you completed your service, and then you record expenses and payments when it is incurred, when the minute it happens. Okay. All right. Other than that, any questions in regards to anything on chapter 4?
No, ma'am.
It's a lot of information. Again, this is pretty much sums up the guidelines and what you're expected if you are an accountant.